Dividend yield explained. When you're evaluating dividend-paying companies, you should pay attention to the dividend yield. It is one metric which will give you valuable insight on the company. The dividend yield tells you the percentage of dividend you get compared to how much you paid for a share of stock. The formula to calculate this is the annual dividend divided by the current share price. So the higher the dividend yield, the more dividend you get for your money, and vice versa. There are certain companies and industries that have always paid out a high dividend yield, like REITs and MLPs. REITs have to pay out at least 90% of their income out as a dividend. So a company that pays a high dividend is a keeper, right? Not necessarily. Let's say there are two companies which pay out a dividend. Company A pays $1 and Company B pays $2. If you don't know the share price of these two companies, then you cannot make the right decision. So let's add more numbers. Company A's share price is $15 and Company B's share price is $60. Company A has a 6.6% dividend yield and Company B 3.3%. Looking at the dividend yield alone would tell you that Company A is the better choice. But that could be a lie. You have to be careful with companies that have a high yield. Usually when this happens, it means that the share price has come down. For Company A, the dividend stays the same throughout the year, which is $1. But the share price will fluctuate up and down. So if the dividend yield is high, because the share price has come down, it might mean that the company is going through some bad news, which made its stock come down. Further investigation is necessary. Also, when a stock has a high dividend yield, it usually has a slower dividend growth rate. For example, AT&T or Verizon. AT&T has a higher than average dividend yield at 5+%, which looks great on paper. But year after year, they've grown their dividend at a measly 2.2%, which is less than the yearly inflation amount. On the other side of the coin, you have companies with a lower yield, but they grow their dividend at a faster rate. For example, the clothing company Ross Stores has a dividend yield less than 1%. It's actually 0.8%. But the interesting part is that the growth rate, even though they pay out less than 1%, their growth rate is in the double digits. The last 5 years, they've grown their dividend on average by a crazy 19%, a great many times higher than inflation. So I have noticed this correlation. High dividend yield, slow growth; low dividend yield, high growth potential. When a company pays out a higher amount of their net income out as a dividend, they are limited in how much more they can pay out to shareholders. That's why you also need to pay attention to the dividend payout ratio. AT&T's ratio is at 92% while recording this video, and Ross Stores is at 20%. So Ross Stores has a lot more leeway to increase its dividends without getting into any financial problems. You could also look at it this way. A higher yield, slower growth company means more invested money that you get back upfront, but with slower growth thereafter. And the low yield, high growth company means less invested money back, but your dividends grow at a potentially very high rate. Then you also have the middle of the road companies that have an average yield and an average growth rate. So which companies should you have in your portfolio? High yield, low yield, or average yield? Well, it depends on your investing style and your age. Older retired investors would be better off focusing on getting a high, stable return from their investments. Myself, I have all three in my portfolio. I like the high yielders for their upfront cash, like real estate investment trusts. I also like the low yielders for their growth, like Ross Stores. And I like the average yielders, which will give you a little bit of the best of both worlds. One more thing, when calculating the dividend yield, you need to have the annual dividend amount. This dividend can either be trailing, a forward dividend, or current. A trailing dividend is where you take the last 4 dividend payments to come up with the annual amount. A current dividend is where you take the last dividend payment and multiply it by 4, if the company pays out a quarterly dividend, of course, to get the annual amount. A forward dividend is where you pull in the projected dividends a company presents for the year to come up with the annual amount. Which one is better? I like the forward dividend, and many online sites like Yahoo Finance use this dividend also. If I don't have access to the forward dividend, I just use the current and multiply by the yearly payment amounts. So guys, I hope I was able to shed some light on the dividend yield and why it is one of the metrics you should pay attention to. If you like this video, leave a comment, hit the like button, and don't forget to subscribe to my channel. I'll talk to you guys in the next video.